Hi, and thanks for watching episode 7 of our trading series. My name is Vincent and I work at Maven. Today I would like to discuss trading futures. First of all, you're quite new to the concept of forwards and futures, so we need to discuss a little bit upfront. Let's say a small simplified example. If you would like to buy a car today, you go typically to a car dealer, you pay the money there, and you get the car in return. It's a very simple transaction. We would call it a spot transaction, right? You swap the money for the car. Instead, you can enter a forward contract. So basically, if you do this, there won't be any transaction of money. It's just an agreement for the future. You're basically telling the car dealer in, I don't know, a month from now, I'm going to buy the car for 10 grand. And it's kind of an obligation. You agree with the car dealer that this is what's going to happen. So today there's an agreement, some time lapses, let's say a month, and there the transaction takes place. Well, why would you like to do such kind of a trade or set up such an agreement? Well, if you are scared that car prices might rise too much, then it's nice for you to kind of fix the price right now. And for the car dealer, the same thing applies. If the car dealer is scared that car prices might fall, then for him it's nice to kind of lock in his 10,000 guaranteed income. An extra thing you need to know, if these sort of agreements are structured on an exchange with kind of set specifications, we would call it future contracts. And these things typically are interchangeably used in finance. I've got a question. What would you rather do when offered to you? Either you can pay $100 for a couch today, or you pay $102 for the same couch in half a year from now. And I need to tell you something extra. You can earn 3% interest rate on your bank account. Well, let's verify. If you don't pay it today, you keep your $100 for half a year. And with that half a year, you can make $1.50 during the period on the bank account, right? You get 3% over your $100 for half a year, so you can earn $1.50 in the bank account. So this tells us that the actual true value of this forward contract has to be worth $101.5. Otherwise, there's something wrong, right? That tells also us that paying 102 is too much. Option A is better. Option A is better. So it should be worth 101.5, but paying 102 is too much. So option A is better. Although I see that on the presentation there are two A's, but the first A is better. This is it in an illustration. It's a bit of a complex graph, but it's try to explain it. The black line is the spot. It moves up and down. The actual car price will move up and down, and so will the future follow. If you did some math, then you can see that the future or the forward price is a function of the spot. So it will kind of track it down. But you can see that this difference is kind of narrowing down. So today, and let's do the analogy of the couch again, this would be your 100, and this would be 101.5. And as the time is approaching the maturity date of the whole agreement, which is 1 month in the analogy, kind of the time component runs out. Right? Time is lapsing, so the difference between the spot and the forward will go smaller and smaller, just because kind of time runs out. And at the very maturity of the thing, the spot and the future will trade on at the same price. Note that this number can be much higher or lower. It's not the case that we started with 100 here, but the prices of couches, they can vary wildly across the month, and we can end up here or we can end up here. The main takeaway is that the spot and the future will be at the same point at the end of the maturity. Okay, on the next slide, I have a real-life example of where we can set up a lucrative trade. There's a lot of information, but let's have a look. So assume today is the 18th of March, and we talk about Tesla stocks. And today they trade $800. And this means this is the spot price of the stock price. And interest rates are 3%. Look at this screenshot. It's a bit of a professional screenshot, but hopefully you're used to it by now. Because as you remember, the stock is not one number. It's not that 800 is fact. There's always a bid and an ask. So let's say the bid is 799.95 and the ask is 800.00. And also the June future contract is a contract that trades on the exchange. The The best bid is 806.5. Think of the order book before, and the ask is 807. Now, if you see something like this, we can spot an arbitrage opportunity. And arbitrage means you can set up a trade that will guarantee you a profit no matter what happens. First, let's grab the formula back. The forward price or the future price has to be 800, the spot price, plus the interest rate component. It should be 806. That's what the forward price has to be. But if I look at what is trading in the market, it's trading higher. It's trading 806.5 at 807. So the lucrative trade to do is to sell. You can sell the bid, right? So that's the dynamics we taught you before. You can buy this and you can sell this from a customer's perspective. So now that we've established that the true value of the future contract should be 806, probably it's wise to sell something that is higher, 806.5. So this is the action you should take, and this is the associated cash flows. And you can see already down here that you will be left off with a profit. So what do? You sell the June future at 806.5. Remember, this is an agreement, so there's no cash transferred involved. By doing this, you just agree with someone else that you are going to sell the stock at 806.5 in the future. And what's the future? 3 months from now. So 3 months from now is the June future contract. Because today we are in March, and in June it's 3 months from now. So the time frame here we talk about is 3 months. So you sell this thing, there's no cash flow involved. What else do you need to do? You need to borrow $800 from a bank. And why? Because you have to buy the spot. You also have to buy the spot in the market. Because if you only sell this thing, you are kind of massively subject to fluctuations in the stock price. So what you do, you sell the June future, and you're going to buy the spot. But you don't have the cash up front. So therefore, first of all, you do this. Then you borrow $800 from a bank. And with that $800, you buy the spot in the market. That will cost you $800. So, okay, the bank gives you $800. That's $800 in your pocket. With that, you spend $800 again, because you can buy the spot price at $800 there. Then what else do you need to do? We have to wait 3 months, but meanwhile I have to pay interest rate to the bank, right? I borrowed $800 from a bank, and throughout the 3 months I have to pay 3% interest rate over that period, which comes down to $6. So $6 I'm going to lose on the way. And after 3 months, I need to fulfill my future obligation. I told in the agreement I need to sell the stock at 806.5 to the other side. That's what I'm going to do. So when I do this, I sell my stock, 806.5 is what the cash flow in is there. Oh yeah, I need to return the $800 to the bank because I borrowed it there. Yeah? So if you add all the cash flows and you can pause the video, you end up with exactly 50 cents, which is what you expect, because you see this is the theoretical value of the future price. But I could sell it for 806.5. So you could already have seen that the leftover profit is 806.5, but breaking it down into actions, you can actually see that you don't run any risk throughout the period and are just left over with a net profit. Yeah. All right, in summary, the price of a future contract, it depends on the spot price, interest rate, and the time to maturity. When a future is out of line, like in our Tesla example, we can set up an arbitrage trade. The funny thing is that the arbitrage trade is not dependent on whether stock trades during the lifetime. So if you allow me to just go small back, you can see here as well. So these things converge, but where this thing ends is irrelevant. So the Tesla share can be there or there at maturity. Because you set up the trade in such a tight way, that's totally irrelevant. In reality though, there are subtleties. Forget about the variation margin now, but let's say in this formula, you assume that the interest rates are fixed, one number throughout the whole period. But the interest rate itself can move across the period. So those are small, minor subtleties that can change the theory a little bit. But hopefully it gave you a bit of an insight into what future trading entails. And stay tuned for further episodes.